Hedgeless Horseman here. It's January the 2nd, 2023. I'm not used to saying that. First of all, Happy New Year. Uh, I hope you had a great New Year's Eve, and I hope that this year will be very productive, let's say. I just thought I'd make a quick video on value investing and risk reward. I know I've made a bunch of these videos before, but I think it really is, as always, one of the most important aspects, especially how it helps you think about price, in my opinion, and also, focus on what is important. Let's say, because there's a user here in the Magna Mining forum. Who said, "I'm not sure I want to be patient. Thanks to Horseman, I'm sitting on a 62% gain here. Being patient with almost all my resource development / exploration stocks has led to massive losses and heartache over the last few years. I'm fighting the urge to sell now and take a guaranteed win." I think this is, these thoughts pop up in most investors' heads, I mean, including my own, a lot of the time. And I think it's very context related. First of all, when he says, my resource development exploration stocks has led to massive losses and heartache over the last few years. Okay, let's check in with the good old trusted junior miner sentiment proxy, Bear Creek Resources or Bear Creek Mining, whatever. Yeah, Bear Creek Mining. Not a mystery here. It's like, yeah, if when this sector hits a medium-term peak, you're gonna be down. This was a peak, and then it won't end until we have a final flush out, basically. We don't know when that happens. I mean, here it happened at this level. Here during the COVID crash, it bottomed here. We don't know when or at what level it's gonna bottom. We just know that this sector crashes like 50% every 2 years, and every 7 to 8 years it has a massive, like up to 90% correction. That's all you need to know. Can't take that personally. You you automatically do not become a bad investor just because you sat through this and almost all of your holdings are down. That is actually, I mean, that's to be expected. There's no way of getting around that. There's simply more money leaving the sector, and at the bottom, nobody cares about, you know, fair valuing or fair value of a bunch of these juniors. No, it's just a stampede. It's literally a stampede. Price to value is nothing people care about down here. And also you have, tax loss selling and yada yada yada. That's just how it goes. And again, after this sector crashes, it typically can ramp, I mean, by an incredible amount in a short time. We saw Bear Creek Mining here, for example, 205% in, I don't know, a month. I mean, 205% with no real big change. And it's not the only junior that's gone up 200% from the bottom. It's just how this market works. Can't take it personally. Bear Creek Mining is not, a much better company here than here. No, it's just how the herd moves, basically. Everybody who was thinking of selling had sold out. So the path of least resistance is like, if there's nobody left that is willing to sell shares at this level, there's no way for the price to go down. It can only go up. Because nobody's gonna sell. I mean, this we know in hindsight. Nobody was prepared to sell at a lower price than this. But some were, and at one point or another, everybody's gonna be out. As is here, nobody was willing to pay a higher price, and we peaked. So that means there's only sellers left. because the last guy on the ball, he was willing to pay this much but no more, and nobody else was willing to pay more. Okay, so it literally will not go any higher because there's nobody that's going to buy at a higher price. So path of least resistance is down, and we get the eventual flush, etc. So, I mean, first of all, you can't take this market too seriously. I mean, a lot of people, especially traders, because it makes sense in from their point of view that the market is always right. I mean, if you're a trader, the only thing you're looking at is what the actual price does. That's everything you're looking at. So from that perspective, if you're simply a trader, of course the market is always going to be right. But from a value investor standpoint, I think you're better off always assuming the market is always wrong. Otherwise, you're not going to have the conviction of fortitude, etc., to bet against the market. Because by definition, if you're buying something, you're basically saying that you're taking a stand against Mr. Market, the marginal investor, because if you're buying, somebody sold you that stock. So you're taking the opposite position of the one who sold it, the marginal investor, which is Mr. Market. So just the act of buying or selling is taking a opposite view of Mr. Market. And that's what I don't get. It's like people say, well, the market is always right, yet people, try to stock pick. How on earth does that go together? If you say the market is always right, it means you can't beat the market, and yet you're trying to beat the market. It's kind of I guess a paradox. But anyway, his thoughts here is like, I'm sitting on a 62% gain here, and I don't know what to do. Basically, I'm fighting the urge to sell now and take a guaranteed win. So it's obvious that like at this point in time, when we're down here, especially when we've been down here, and some juniors are still near their 2-year lows, profits are very rare. It feels very rare. It feels like for 2 years, it's felt like seeing green in a stock is like the rarest thing ever, especially if you entered here, for example. And it, you get paranoid, like, I mean, these gains are going to evaporate, etc. Because it basically has happened like that a bunch of times. I mean, this was kind of a big rally in the juniors, but then it went lower. So these, paper profits evaporated, and down here it went up here, and then they evaporated. And so we've been taught for like 2 years that paper profits will disappear if you hold it long enough. And I mean, that kind of makes sense, because like we see, when you have a lot of paper profits, this sector will one day turn down and the profits will evaporate. Same, on flip side of the coin, the losses will evaporate as well. I mean, literally here, I mean, if you bought at any time here, even if you were down 90% or 95 or whatever, you made all that money back, and then you lost all that money. And then you made a lot of it back and almost, lost a big chunk of it, then made a lot of it back and then lost. That's just how this sector works. So from a, big picture perspective, I'm waiting for us to hit, these kinds of sentiment levels again, because it's in my opinion just a matter of when, not if, because otherwise there's one would say that there's no chance that this sector will ever become hot again, and that hasn't. I mean, that's not the case since for the last 100 years. This sector has been around forever, pretty much, and we will, like always, go from fear to greed to fear from greed, and we're nowhere near greed levels yet. So when we go here up to here again, I think a lot of people will be making money. But of course, I mean, what people usually do, and why I think you have to be in this sector for at least 4 years, because you can't just look at, if you start investing here and you're down here 2 years later, and you're like, yeah, you can't make money in this sector, I'm a really, really poor investor, etc. That's not a fair estimate of your investing skills. If when we go back up here, yes, then if you're down from here to here, then you probably are doing something wrong, let's say. But it's the crashes, what comes after the crash, that pays for the actual crash. It's totally irrelevant what has happened. It's only the future that remains. So on that point, it's like, what is ideal value investing? I don't think there's any strict rules. I mean, I know there's, it's kind of popular to have the sell after a double mentality. I think basically that's a psychological crutch. Like, okay, I take the money I put in off the table, so if I lose all of that, which is left, basically break even on that trade. That makes no sense to me. Let's say you have, take Magna for example. Let's say you, for some miracle, you were able to buy here 24 cents. Then it jumped up to 48 cents on the day of the announcement. I would say the announcement of the acquisition and the Green Hill mine maiden resource estimate, I would say the case is a lot better here than here. So let's say you start off with a 2% position here, and you go up to 4 after it has doubled on the news, etc. And you're like, yeah, okay, I take half the money off the table, so you go down to 2%. What you're saying in that case, by your actions, is that you think this case is, the risk reward is exactly the same here as here. Granted, the price was much lower, which is, typically hikes up the risk reward. Still, I would say that at this point, the case was a lot better because the margin of safety and the upside increased by hundreds of percent. So from that perspective, does it make sense to take half of the money off the table simply because you have 100% paper profit? I mean, the past is the past. Doesn't matter what has happened. What matters is what's gonna go, on in the future, etc. And again, if price goes down, price goes up while value is flat, that means risk reward is decreasing. Because let's say we have the fair value for Magna. Let's just pretend that it's up here. This is the margin of safety. This is not like taking exploration risk that it might become this valuable. Let's say just right now, based on all that is known, fair value, not overvalued, not undervalued, fair value would be around here. That means there's 157% risk-adjusted, quote, free money left on the table. I don't know too many stocks that have that amount of risk-adjusted free money on the table, and with the kind of margin of safety the team. And I mean, there's a bunch of microcap companies that are trading for, nano caps that are trading for just a couple of millions or whatever. But and yes, they might be undervalued, but they are typically very high risk, high reward. Let's say they don't even have a real target, etc. So it's like, yes, from a mathematical standpoint, that might be true that they are very undervalued, and they might go up 500% when this sector goes from here to here. Still, I mean, it's not easy to get a big position in a nano cap. First of all, it's like you might be able to buy $2,000 worth of shares, and then you move price up 10%, and immediately the risk reward decreases, etc. And also you can get stuck in those stocks, and something might happen, yada yada yada. Anyways, like from a risk reward perspective, I much more prefer the risk advanced juniors, especially when management has a lot of skin in the game and a lot of they're very competent, let's say. But from a strict value investing perspective, and it's like value trading, if there's been no news from this point here to this point here, but the price has gone up, what has actually happened there? It means that the current price, Mr. Market's daily price relative to the fair value is decreasing. That means the risk reward is decreasing because price is going up, but with no news, no, let's say big news, value has not increased. Sure, there's a lot of contextual things out there, like, nickel inventories are very low. We see talk about governments focusing more on securing critical supply, etc. So one could say that, hey, there's favorable tailwinds that is not strictly tied to Magna but tied to their business. So one could say, hey, I think maybe value has gone up a bit, but let's pretend that it has not gone up. So let's say here, after the announcement, big announcement made in Resource, let's say if you had a junior focused portfolio and you were not playing with all your money, etc. Let's say the case was so good, it's like by far the best case that you can come up with. The risk reward is just absurd. Let's say it's undervalued by 400%. This is obviously the time when you should have the largest allocation to that particular stock. And as price goes up, this price to value gap narrows a bit, and by definition the risk reward gets lower. So if the stock goes up 20% in price and value doesn't change, and you started off with 30%, then obviously you would have like, what is that, like 36% in Magna. But as price goes up and value goes down and risk reward goes down, if you held that, yes, you had 36. But what you're saying then is that if I have 36% in Magna right now after price went up 20%, that means you're basically saying that I think it's an even better case because now I have 36% exposure. In reality, if it goes up 20%, maybe the let's say optimal allocation should be down to, I don't know, 25%. So you should have sold it down so you have 25% position left because risk reward is decreasing. And if it goes back down, let's say up here you had, well, let's pretend you have 20% position. So you've taken some gains, not because you have any strict rules. It's just that as price increases and value, let's pretend it has not increased, that means the risk reward is going down. There is less risk-adjusted free upside. So by definition, the opportunity is decreasing. But then let's pretend it went down to this level again, that it didn't stop here, it actually went down here. Then you would actually buy back, so you had 30% again. And then it went up, and let's again say value didn't change, but price went up, so risk-reward decreases as this price to fair value gap decreases. You would again sell down, and not, if you had a 30% position here, maybe you have a 20% position here. So it's like, that's not predicting what the market will do. That's reacting as a value investor to what the opportunity Mr. Market offers on any given day. That's how you use volatility. And again, it's like if I have a bigger position now in Magna than I've ever had allocation wise. Why? Because I haven't sold anything yet. From a totally rational perspective, that is irrational. Because what I'm saying is that I have more exposure to Magna here than I had here. Even though what has happened is that price has gone up, the risk-adjusted free money has gone down. So in reality, one could say the case has decreased. So I mean, I'm not perfect from that sense. It's just that, okay, opportunity cost. any better stories. I mean, the opportunity cost at any given time is that, do you know cases that are better? Are the money spent better in another company? Let's say you find Magna 2, but it's priced here. Obviously, that would be a better risk reward than Magna 1.0. I haven't found any real, you know, I still think, even with this price increase, I still think Magna mining is probably the best risk reward case I know of still. So it makes sense to have a big that as my largest exposure, if you know what I mean, because I don't see any other place I could put my money where the risk reward is as favorable as here, with all the margin of safety, and obviously, like, from a long-term perspective, I mean, this, I don't think the value will stop here. I think the value, since, I mean, this management team is so good, I think that, let's say fair value is up here, I think it will keep on increasing. So the actual price to the value 1 year from now might be 453%, which is absolutely stellar. And of course, that you have to compare with other stories. Like, let's say you find something that is not as cheap right now as Magna, based on what is known because it's so de-risked, yada yada. But you think, hey, that company, which is a bit more expensive than Magna, will have an even higher growth trajectory, let's say. So today you're paying more for that company, but the base case is that it will have created even more value than Magna over the next year, whatever. So maybe it actually has your base case is that it trades at a price to future value gap 1 year from now of 502%. Actually, that would be even better than Magna in that case, even though you pay for it's a bit more expensive now. But again, it's like the value creation curve is even steeper than Magna's. With that said, I mean, typically if it's very steep, it typically means it's quite risky. I mean, potentially at least. And as always, you can't compound a loss. But I can't come up with anything really which would, I mean, what would make Magna worth less than what I'm paying for today? That's the margin of safety aspect. Or it's like, yeah, okay, nickel could crash by 33%. In that case, maybe Magna is close to fair value right now, but I can't bet on that because that has not happened yet, and I don't know if that even will happen. And then they can hit the, footwall discovery, and maybe they'll make good money actually on toll milling, even if nickel prices are down 30%. So that's what I love about the margin of safety. I don't see, let's say, the risk of the current valuation of Magna to become overvalued in the future. I don't see that as very high. I really like that because, as I see it, let's say based on where nickel is trading today, let's say it's okay, this should go up 155% at least to reach fair value. And when let's say price continues to climb, but they also continue to create value, then basically if the price and value slope would be completely similar, there would be a constant gap here of like future 154% expected future returns. Because again, it's like, who cares what has happened? If you're in a if you have a profit or a loss or whatever, investing is about the future. We can take back the past. That's irrelevant. So if I don't care if I'm up 200% or minus 80% on a stock, I want to be in the companies with the best risk reward at any given point in time. So I might sell junior, I'm down 80% in, and I know it's like a lot of people, uh, think the way that I have to make back the money the same way I, lost it on paper. That makes no sense. I mean, if you're down 80% in a stock, and the future for that stock is like, something terrible happened, so it has no real business of going up again, that's a sell. So why would you keep dead money in that stock when you're like, hey, there's companies out here which I think can, do 300% over the next 2 years, whereas this, I'm down 80% in. I don't see any real reason why it should go up 300%, except if sentiment really kicks off. But I don't like to bet on that. I much rather prefer, have the conviction like it's a bull market, but assume it's a bear market, and just pick companies based on their individual merits, not because, I mean, if your case is, which I think goes for a lot of people, your case is, hey, I'm gonna make a lot of money if silver hits 50 or gold hits 2,500 or whatever. Okay, that means you're gonna be constantly emotionally tied to the price of metals, because that's all your case is. If metals go to the moon, I'll make money. How do you keep conviction when metal prices are down in that case? Because that is all your case is about, where the price of metals go and what you think will happen. I think it's a lot better to focus on the companies. How much value are the companies going to create? What are they trading at now? And then the risk reward, like in poker. I mean, if I were to just, make a poker reference, let's say right now the risk reward in Magna, given all that is known, yet we can't predict the future. Let's say it's a pair of aces right now. Let's say up here, if nothing changes, it will go down to a pair of kings. You would bet less on a pair of kings than a pair of aces, for sure. And lower, it would be, super reduced pair of aces, let's say. And on position size, it's like, we can't be perfect. Sometimes it takes time to like really appreciate how good a case is, for example. And take Magna. Let's say that at this point in time, when price was here, the risk reward was so good in Magna that you should have 15% of a concentrated portfolio in Magna alone. Okay? Let's say you buy in here with 5%. And let's say it goes up to, thanks to price going up, but value does not go up. Price goes up, so you're sitting at, let's say, 8% position here. Wait. Let's say you buy 5%. Let's say it goes up to, so it's 9% position here. Simply because you didn't take any profits off the table, but you know that, okay, risk reward is decreasing because value hasn't changed, price has gone up. So again, from an ideal value perspective, risk reward is going down, so you should take money off the table, because if you were prepared to invest 5% here and it goes up to a 9% position, while the risk reward has decreased because risk reward is decreasing, you should obviously have less than 5% in Magna at this point in time. But if you toss and turn and think about the case and all of that, it's like, yeah, hey, I mean, I think actually this case is still so good despite the price increase that I think I should have a 15% position in Magna. Then you should actually be adding, despite the fact that risk reward is going down. And in hindsight, at this point, you're thinking like, hey, I shouldn't have 20 here. I should have I shouldn't have 5% position here. I should have gone in with a 20% position and decreased that to 15 instead of starting off with 5, going up to 9 and having to increase to 15%. So it's all is context, etc. That's why I don't believe in strict rules at all. And that's why I never, it's like, again, if I'm up 100% on a case, Bear Creek Mine now, not Great Bear Resources. Okay, let's say you are in Great Bear Resources, you have a 10% position, pre-discovery. You're sitting just, I think they might find something, yada yada. I won't take such a big position because, a great success is never a guarantee. A big discovery hole is certainly not a guarantee. They make a discovery. Stock goes up 100%. So your one position turns into a 2% position. Okay, again, most people or a lot of people would then, using the, sell half if you double, they would sell half, go down to a 1% position. So they're saying the case is as good right now after the discovery hole as it was prior to the discovery hole at a 50% lower price. That's what they're saying with having the same allocation. Where in reality, maybe the case got 500% better because now they have a discovery hole, and that means that, hey, this market cap of, I don't know what it was trading at, let's say $40-50 million. This suggests that, hey, this looks like a really big target. We know what happened. It got sold for like $1.8 billion. I would argue that many companies, the risk reward can be better after it has gone up 100%. It all depends on the context. What has actually happened, news, etc. Again, if value hasn't gone up and price has just gone up, by default risk reward decreases. So if you thought perfect allocation was 20% here, you should have sold down to 15 because there's less upside room and more downside room. But that's not set in stone, because let's say you have a better grasp of the company, like, hey, I should have had, I don't know, 20% here. No, I was going to say I should have had 25% here, and now I should actually have, no, that's not good either. Let's say in hindsight, you thought you should have, the risk reward was so good that you should have a 20% position here, and it goes up, and it's like, all else equal, you should have a 15% position here, but you only bought in for, like I said earlier, like with 5%, so you're up to 10. But you should actually, when you understand the case more, you're like, this is actually, I made a mistake. I should have gone in way heavier than 5% here. I should have gone in with 20%, and now it's worth 15% in terms of an allocation, but you're only up to 10. So then in that case, you would be adding, again, despite risk reward decreasing, because let's say no news was out. Unlike Bear Creek, Great Bear Resources, where it's like discovery hole obviously changes the risk-adjusted value. But here on no news, that could still be a buy or a bigger buy, simply because you have a better understanding of the case and you just realize, hey, I should have gone even heavier down here, but still, okay, after it has gone up, whatever, I still actually should have more exposure. And what I mean, the main, let's say, moral of the story or lesson is that what has happened is absolutely irrelevant. Yes, we will have like you've seen here, it reaches some trading pivot zone, and there's gonna be people who take profits because everybody's a trader nowadays. Sure, but for a long-term investor, that doesn't matter. And if it goes down here, you should know, because I've seen that. I saw that almost every time way up. People bought on any given day, and then it fell lower within the same day, and they're like, yeah, I think I made a mistake. Or, typical of me. I mean, yeah, but everybody's been calling tops and etc. all the way up. And it doesn't matter. Only the future matters. I don't care if it's up 100%, down 50%, up 200%, whatever. What is in store? How much more risk-adjusted money is still left on the table? If the risk-adjusted fair value price-to-value gap has gone again from like 293 to 156, obviously that has been cut in half. So it's worse risk-reward here than here, all else equal. Still, if this is the best story around, that should still be your, biggest exposure. But some would say, like, maybe take all profits. I mean, if you take some profits, that's fine. But if you, again, if you had a 1% position, it goes up to a 2% position, and you take some profits off the table, so you have a 1.5% position. Yes, it makes sense, again, from the standpoint of risk reward is decreasing based on everything that is currently known, because no news has been out. But still, a rational position size might be 8%. So you shouldn't be selling at all. You should actually be adding multiples of what you already have. And yes, in a perfect scenario, we would already know that down here, and maybe take a 15% position instead of a 1% position and go down to whatever. That's true, but it's like perfection is absolutely not needed in a sector like this. I mean, if we're even half right, I don't know exactly what the fair value of Magna is. I'm pretty sure it's considerably higher than where it is. And then I think the management team will create value. So even if, let's say, fair value will be down here, but yes, it's a good management team. So sure, yes, you overpaid for it today based on what is confirmed, but not based on perhaps what is known about the skills and the assets, the exploration potential. So I mean, the growth is, in that case, the value creation is going to bail you out anyway. So what might have been you overpaid for what was confirmed today, but not based on what is known. So in like I don't know, 1.5, in 6 months, maybe value will be up here. We don't know the future. All we can do is make assumptions. And if you can find a case where it's cheap, really cheap based on what is known, and you think that this team and asset can, create a lot of value, the team can create a lot of value from the assets they have, or maybe they're good at acquiring assets like they did with, like Magna did with Green Hill. I mean, the expectations are that the value will just keep going up. So even if this remains, let's say considerably undervalued to what is confirmed, as value increases, you're still going to have a positive trajectory, because if value increases like this and price still trades at a hefty discount to fair value, as value goes up and you have the same gap, you still have an uptrend in price, even though it might look like something like this, obviously. I don't know if this might have been too chaotic, actually. I thought it was going to make I mean, these are the potential value adds, risks to the upside that might be in store. And again, if I mean, real results, testing feed, I mean, that would pretty much be bonuses. Again, it's like, if fair value is here based on what is confirmed, if they have hit a football discovery, maybe the value jumps up here. If we get a grant, maybe the value jumps up. Well, not maybe that much on a log scale, but it's like, let's say potential exploration success could get it up here, and then you have a grant which would put it up here. Maybe, I mean, there's a lot of upside surprises, and again, if this is already fair value, that means that any upside surprises beyond that would be free money. Uh, but I guess again to sum up, personally, I don't think you should think at all of about how much you're up, how much you're down. You should only at any given point in time look at the current price versus your expectations for the future, and what is known. Let's say if there's margin of safety in hand, because some exploration stores might not have a lot confirmed, but it's like obvious that the system is wide open. It's like Great Bear. Of course, it was uh, like people say, hey, this exploration stock is expensive. Yes, they tend to be expensive based on what is known. It's like take take Great Bear. I mean, after just a few drill holes, I mean, you don't have a resource after a few drill holes. So so let's say based on a drill hole or something, maybe price was here and confirmed value was down here. So you're overpaying right now based on what is confirmed by a mile. But let's say the base case growth trend, given what how good the discovery hole was something like this. So yes, you might be overpaying now, but in like a year or so, maybe this will look very cheap. That's like paying up a higher PE for a growth stock. Yes, it's a high growth stock with a high PE. They are expensive on the now, but not based on expected future. So it's like I listened to a recent interview with Monish Pabrai, who's a great value investor, and he said, like, I mean, Walmart 30 years ago, in hindsight, was a buy at a PE of 50 or 100, because they had so much growth that even if you paid a nosebleed premium on the current business, their expected growth, or at least what turned out, how the growth turned out, in just a few years, that looked cheap all of a sudden. So you could have made a lot of money buying a PE 50 to 100 company if there was a lot of growth in store. But you might be overpaying for the now. In case of Magna, I don't think we're overpaying even for the what is already confirmed. Meaning it's like, yeah, we pay a PE of 5 and it's still a growth company to boot. So that's why I think the risk reward in Magna is still really good. And again, from a totally rational value perspective, I should have less up here exposure to Magna than here. But in hindsight, or in reality, I maybe should have had more here than I had, and now I might have an optimal position sizing. It's just, okay, based on what we know today, what is the risk reward? Are there any better stories out there with better risk reward? Okay, if it's the best risk reward we know of, again, not knowing the future, but if it's the best bet we know, okay, by definition, you should have the biggest exposure to the story at this very price. Not at this price, but at this exact price. Okay. So what is the optimal position sizing? That you have to think about, because there's no guarantees in this business. Let's say if I had $1,000 to invest, I'd probably put it all in Magna. But the more you have, it's, I mean, from a liquidity standpoint, etc., and yada yada, risk exposure. I mean, if you risk $1,000, that's not a big deal. If you have $1 million to invest and you put it all in one stock, I would say that is way too risky, because okay, anything can happen. I mean, there's no guarantees, but maybe it's like, hey, I should have a 6% position. Okay, if you're above 6% in Magna, you should sell. If you're below, you should buy. The past doesn't matter at all. Everything is about, or what price we're paying today and how good the risk reward is in light of what is currently confirmed and known and what we expect from the future, and then adding, some probabilities. We know Jason has said that he won't sell a single share before he gets Magna to $1 billion market cap. Current market cap is 130. That's not, we don't know how long that would take and all of that, but it's like, okay, he has one of the biggest, he's one of the biggest shareholders. We know a lot of long-term smart money got into this story. I don't think they're after 100% return, etc., etc. So, from going just by Jason's comments, theoretically, if I were to keep my entire position now, and Jason's vision of a $1 billion company plays out, even if it takes 5 years, I would be able to more than retire on Magna alone. But it would still make little sense from a value investing perspective, unless because let's say I don't know what price we would hit $1 billion at, but let's say it's here. Let's say we do hit 1 billion, and let's say the fair value goes something like this, and we hit fair value. Obviously, if we hit fair value and it trades at 1 billion, it would make no sense as we're closing in on 1 billion to have, because my exposure to Magna would be absolutely enormous in that case. Let's say, you should not have 95% exposure to one stock, Magna, just because, we're going to hit that 1 billion. But if we hit 1 billion and Magna has a fair value of 2 billion, that's still something you shouldn't, totally sell out of. You should certainly not have a 95% position, because it's that's just irresponsible from a risk management perspective. But again, everything is based on what the price to value gap. If Magna hits 1 billion and fair value is 1 billion, you should sell everything. If we hit 1 billion and the fair value is 500 million, you should have been out a long time ago. If we hit 1 billion and the fair value is 2.5 billion, you should maybe have a 10% position still. It's like, what is left? What has happened is irrelevant. What is left in store? What is the quality and the risk reward of the case from the current price in light of the future? And that's why, like I've shown, it's like if we were again totally rational, maybe we would have 30% down here and 15% down here. But if we were not rational from the get-go, we had 4%, but we should have 15% right now. We should be adding, not selling. So that's why it's so hard when people ask me a particular case, like, do you think this is a buy or a sell right now? And it's like, that totally depends on what your exposure is. If it's the best case around, but you have 70% of your portfolio in it, for you that's a sell. You shouldn't have 70% exposure to one story. If it's the best story around and you went from still a best story around and you went from 1% to a 2% exposure, maybe you should add. Maybe you should have 10%. Maybe you should 5x your position size, even after being up 100%. So it's all down to, again, it's like every investing is not a science, it's an art. And it all, again, depends on what the case is at any given moment. If Magna tomorrow jumped to $2 per share, the risk reward would decrease a lot. If Magna tomorrow dropped 25% or whatever, the risk reward would be a lot better. So if you had 15 here, you maybe should go up to 20% added on the dip. If you had 15% here, maybe you should have 1% here. Again, assuming nothing else changed. So again, a buy to someone is a sell to someone else, even if both see the case the exact same way, simply because the difference in exposure they have. So I don't know in this case, I don't know what his position is. He's sitting on a 62% gain. Let's say it's his 15th largest junior position. I would certainly not sell, because I think it's one of the best in the entire sector. But if he put in, again, I have no idea what is how much this guy is in for, or his risk tolerance and his perspective and anything like that. That's why I don't give out buy and sell recs, because it all depends. I'm trying to outlay how I think, what I think the risk reward is, and what are the potential ups and downs, etc. But I can't copy my context, my situation to everyone else. I have a risk tolerance that is way higher than most people. That doesn't mean everybody should do the way, have my exposure to any story or whatever, because I know how I kind of work. I know risks. I'm comfortable with volatility because I've seen all these crashes before, and I have a longer term perspective than most. Again, when I'll be hopefully at least out of beta place, that would be up here somewhere. We're not even close to that right now. But I don't know if after Bear Creek, for example, having gone up 205%, maybe it goes down here. Maybe we hit this rail again before going up. I don't know. I just know the price is what Mr. Market gives us every day, and then we have to figure out what is this stuff actually worth, how much do I think it's going to be worth in 1 to 2 years after 20 to 30 news releases are out, which nobody's paying up for today, because nobody's focusing on that. So it's like in the case of Magna, we know that there will be a PA out in 3 months or so. Okay, that's going to be material. I think that's going to be a very good PA, especially if the nickel prices are somewhere around these levels. I think that a toll milling scenario, which they're looking at in 12 months, at these nickel prices, I think it would be an absolute cash cow. I think it's, again, assuming as nickel stays around these levels and not drop 30%, I think Magna is very cheap, extremely cheap right now. And if we get the PA and toll milling or even grants, etc., by that point, if that plays out like that, I think 130 million would look absolutely ridiculous. So again, I assume that the PA will show very, very good numbers at today's nickel prices. Maybe, 500 million from Green Hill alone. So if you have Shakespeare, which is probably worth 200-300 million or something at these nickel prices at least, and you have a 500 million in Green Hill and net present value, are people going to be prepared to buy more than 130 million for Magna, and the stock will be higher? I think so. If they go into toll milling and they actually throw out tens of millions in cash flow, are we going to stay at 130 million? I don't think so. This is the team that has done it before, so it's like where most fledgling producers or developers, I try to stay away from them. In this case, it's like the best team you could possibly ask for, pretty much. They've done it before, literally done it before, and built a success just from toll milling. So if there were any team I would expect to actually be able to pull this off, I think it would be these guys. So I think it's a very, hundreds of percent higher probability of this becoming a successful producer than the average junior. I don't think that's priced in. Yeah, much longer rant than I thought I would do. Again, I might be a kind of chaotic thoughts here and there, but I hope some points came across at least. That it's like risk reward and opportunity cost is not unlike most people who say that, yeah, you saw Magna go up like this, and people like, yeah, okay, oh, I should have bought Magna, the opportunity cost was high. It's like, yeah, I mean, a rising price or a declining price says nothing about opportunity cost. Opportunity cost is not a period of time of a share uh, uh, share appreciation or decline. Opportunity cost is at any given moment relative to all things we can do with our money. So if this was an easy 200% return here, let's say, that is a very high opportunity cost, regardless of what happened afterwards. It's just at any given point. I mean, right now, for example, the opportunity cost in Magna is anything else you can buy at this exact time. We can't just, okay, if price goes up, then it's like, oh, now all of a sudden I can see that opportunity cost was 40% increase in Magna. No, that's not how opportunity cost works. But that's how everybody almost sees opportunity cost. They look at what happens, like, oh, I mean, oh, it's like, I don't know, it's like people think everybody can predict the exact movements of everything. It's like, oh, if you're in a cheap, I mean, seriously, it's like, let's say this was a super no-brainer buy here in Magna still, and it went like this. Some people will say, oh, there was opportunity cost in Magna. No, that you shouldn't have owned it. No, let's say at this point in time, you should have by far the biggest position in Magna, and this even a bigger position in Magna. Just because it went down doesn't mean that there was an opportunity cost. No, you would be stupid not to have Magna at a, let's say, the largest position at this point. Regardless of what happened with price, it just means you should have more here. So opportunity cost just goes up because price of Magna went down. But people again see it like, oh, I shouldn't have been in Magna here because price went down. It's like, okay. It's like nobody's Nostradamus. Just looking at what happens to price is totally missing the point of opportunity cost. That's not how it works. Because opportunity cost is higher here than here. And still people will look at this period here like, yeah, that opportunity cost was over a period of time. I mean, that's exactly not how opportunity cost works, because opportunity is again right now, at any given moment right now. It's not a period of time in hindsight. So again, it's like opportunity cost is fixed right now, and what the opportunity cost was right here will not change depending on if Magna goes higher or lower the next week. It was exactly the same. It's just that fast forward a week, if price is down here, then we have a new opportunity cost. Risk reward is better, opportunity cost is higher. If it goes higher, all else equal, opportunity cost is lower at that exact moment in time. It's nothing to do what happened over a period of time. Anyway, consider me biased. I own a lot of shares of Magna Mining. It's a big position. It's a sponsor. Do your own due diligence. This is not investing advice. Yeah. Anything can happen with a junior miner. They are risky and all that. Never invest money you cannot afford to lose, etc., etc. Thanks for listening.